Hello, my name is Andrew Thake, and I'm a Divisional Director with Resorting Tomorrow. Today, we're diving into the art of advice for investors attending mining conferences, specifically IMARC in Sydney on the 21st to the 23rd of October, and Resorting Tomorrow on the 2nd to the 4th of December in London. We'll be hearing from three industry experts who know these events inside out and have extensive experience within the mining investment space. Joining us from Xcelsior Capital, we have Cailey Barker. Joining us from the founder of the Gold Programme, we have Simon Popple. And finally, from Lion Selection Group, Managing Director, Hedley, Widdup. Thank you very much, gents. Can we first of all kind of kick things off by asking about what's advice for investors preparing for events and what questions to ask? Cailey, for many retail investors or those new to investing into mining, these conferences can feel a bit overwhelming. Cailey, you're attending Resorting Tomorrow in London. What's your top piece of advice for first timer walking into an event like that?
Yeah, thanks, Andrew. I remember when I had hair like yourself and attended these the precursor Minds and Money back in the early 2000s it was, I think, and I was young and fresh and trying to blag my way through the security guards to get a free pass, to try and anything to get into these conferences to just learn about the industry. And it, like you said, it is, and when you're young and green, very overwhelming. Yeah, and I guess, you know, since that time, I've been to the conference most years and many other conferences. And I think Resorting Tomorrow's IP over all the other conferences that are out there in the industry is there's just got fantastic talks and panels. Just the lineup and quality of people that come on those panels is incredible. So the first thing I would say, I would encourage people to get fully involved with those and learn. That's the best way to learn, really, from the top people in the industry about how it all works, what the trends are, and what's sort of topical on people's minds at the moment. Secondly, I guess you know, there's loads of booths out on companies, so you know, have a good mooch around those, talk to the companies, the people that are manning the booths, learn as much about what they've got, and look for some potential gems amongst them. What else? I guess finally is, you know, networking. It's a big conference. There's lots of people. It's very busy. There's lots of people that are bored with and look very angry, but we're all friendly, nice people. So don't be afraid to go up and talk. I get stopped all the time by all kinds of random people. Don't be afraid to just go up and introduce yourself and make some friends.
That's very, very solid advice. Simon, you'll also be at Resorting Tomorrow. When you're approaching a junior mining company's booth or a presentation, what are some of the fundamental questions a retail investor should be asking? What's on the must-ask list?
Well, I mean, I think the first thing, when you need to differentiate between a junior and a senior, so to speak. So I'd say a senior is producing, a junior is exploring. If you're approaching a senior, I'd find out what their costs are. No one can sort of change the gold price or silver price, whatever it is. But if you know what the costs are, then you can work out the margin. A junior, I use a bridge system, but in all honesty, probably don't have time to go through that. So one of the key questions that I have is there another operator nearby? Because if there's an operator nearby, then I wouldn't say it ticks the bridge system, but it goes some way to ticking it, which is balance sheet, resources, infrastructure, diversification, grade, and exploration potential. So, but if there's another company nearby, then hopefully things like infrastructure and stuff will be in place. And also, it's wearing my optimistic hat, there is a logical buyer for that business going down the road. If there's a decent operation nearby, if it's in the middle of nowhere, I wouldn't discount it. But given you may have limited time on the stand, I would find out who's nearby, and then go through the bridge system if you've got time.
Excellent points. Hedley, you're giving a presentation next week at an event I think called Resource Rising Stars, where you're talking about the mining cycle and the line clock. What do you mean by that? And I think also, do you have any additional points to add to Simon and Cailey's comments?
Yeah, definitely. When you're at a conference, it's the best opportunity investors have got, particularly retail investors, to front leaders of companies. You don't get that opportunity in many other industries, and because there's so many juniors in the mining space, you can speak to them face to face, which means you can ask anything you want. And I think you should be brave enough to ask whatever's on your mind. So there's no such thing as a silly question. And there's a number of things you might discuss, but you want to get a feeling for them. And that's a fantastic place to start, is fronting them. But so I'm talking next week about the mining cycle and a concept which we use at Lion, which is the Lion clock. But I think the backdrop to that is that mining is extremely cyclical. It booms and it busts. I think everybody's aware of that. But whether we're in one or the other is sometimes a point of mystification. And that is the most influential factor on your investing experience in the mining sector if you're going to invest. So it's something that we research quite deeply. And I suppose the spoiler alert on that one is, we seem to be seeing money coming back to the space. It's not hard. It's not easy to see where it's coming from, but it's definitely coming. It's probably chasing things like gold, and it looks like other commodities aren't too far behind. So it looks to me very much like we're slipping out of a bust, the tail end of one, and into a new boom, which is very exciting for the outlook for the industry.
And just to follow up to that, Hedley, you've attended IMARC in Sydney and before that in Melbourne numerous times. From your perspective, what are some of the often overlooked questions that can really reveal a company's true potential, or conversely, its weakness?
Yeah, I think one of the things that investors can ask a CEO or a managing director if they're fronting them, and it might seem like a bit of a blunt question, but ask them how much stock they own and how they got it. You're an investor. You want to know if it's worth investing in this company. So if you say to them, hey, mister, I'm really keen to understand how much of this company you own, and they say, I own 100 shares and I got given them for free, I suppose that's one answer. If they say, well, look, I've got most of my personal wealth tied up in this, I've literally bet the house, that's the other end of the spectrum. And that can be encouraging, if you're at that end. It's not to say that people should be investing their whole net worth in the company that they're running, but in the way that they answer that question, they'll often give you a bit of an honesty reflection, I guess, in terms of how transparent they're prepared to be. And I think the aspect of how they got the stock is often the point which is most revealing about them. But I'd also ask them, and Simon made a wonderful point before about, do you have any proximity to existing operators? And I think with a lot of projects in the mining space, particularly with undeveloped projects, gold, this doesn't apply to as much. You can dig gold up quite easily, you can separate it easily, and you can sell it easily, but that's the only one of the mineral commodities that you can. I like to ask managing directors, can you contrast the product which you think you can produce with what is saleable in the industry? And do you think you vary from it? Are you a bit better? Are you a bit worse? Is there anything to be concerned about? Eventually, they're going to have to publish that, and you've given yourself a little bit of a tracer in the water there as to whether they've been prepared to be upfront, whether they're overly optimistic. So it's a good question that you can come back to as they advance and see how their answer measures up to what they're eventually publishing. So that's another really good one, particularly in the non-gold commodities. What product do you think you're going to have? How are you going to sell it?
Thank you for that, Hedley. That does, I think, leads us on to, I guess, green flags, red flags, to go and spot when talking to mining companies, and how we identify the good from the bad. Cailey, from your extensive experience as an investor, what are some of the clear green flags that make a junior mining company stand out to you?
Yeah, that's a good question. I'm intrigued by Hedley's clock system. Is that where we are in the cycle, or is that due to asset quality?
No, it's a where we are in the boom bust cycle. So we're trying to read that, and we commentate on it fairly frequently. So most of our quarterly reports contain that. And the last reading we had on it was it's 5 o'clock, but we're a bit confused. It could be 6 o'clock, and 6 is where you shift from. It's not bust anymore. It's the start of a boom, and then 12 midnight is when the boom flips over to bust. So I'm confident we're a long way from the top of anything. I think we're right at the bottom.
Brilliant. I love that. Yeah. No, I don't have any flash acronyms, and the bridge system that Simon came up with, I love that too. I used to do the P's, it's of people, place, product, profit, that kind of thing. But then ESG came along and kind of ruined the acronym there. So I don't really have that. But in answer to your question, as Hedley eloquently said, I suppose management is always number one for me. It's not just skin in the game, but like, are they real people? Are they not just shysters? Do they have a track record? Not that they need a track record, but do they? Are they quality? If they're good quality management, they'll find assets. Assets will, it's a mining and geology is a pretty grey business in the scheme of things, and very, very tricky and very, very technical. And if you don't have a good management to sort of weather through the clock cycles as well, on top of that, everything else falls away. So I always look at management first. I think secondly, as I mentioned, ESG, that's now sort of, that used to be like number 3 on my list, and is now moved up to number 2, because if it's in a for projects in a jurisdiction I wouldn't travel to, I'm not going to invest there. And I would encourage any other retail investor to be the same. If you wouldn't get on a plane to go there, then don't invest there, because that you've got to be comfortable. But there's all the other ESG aspects as well. I think you need to consider what's their environmental. Are there any environmental issues? Are they in the middle of a national forest? What's their CSR program? Community relations, their social outreach. All those kind of what we used to call soft issues are now sort of pretty hard. So I think that would be the second thing, and then finally for me is asset quality. Which grade is king, as we always say. That does come down to everything, but it's as much as anything is down to ease of extraction. And for me, in what I always excites me most, particularly about junior companies, is what is the potential for it to be a world-class deposit. Because usually, not always, but usually world-class assets get developed or bought. They get developed and turned into mines by someone at some point in time. So if you've got a beast, then, or the potential to be a beast, then that's incredibly exciting.
Hedley, would there be any particularly like red flags that you would add to your list other than share ownership?
For me, the first gate is people, and the red flag which comes up here is the one which so many, I think it's seasoned investors say this, but you kind of need to be a seasoned investor to apply it. And I would encourage people to just try and develop their knowledge around this, because the question is, you're always after management that are honest and competent. But how do you measure that? There is no metric whatsoever. And even track record of delivery of share price gains can sometimes be luck. And some of the management teams, which you've got to be careful of, can't spot the difference between when they've been lucky versus when they were supposed to be just good. So that's a tricky one. But the only way you can measure that is by knowledge over time. And you can build that up. So if you're researching a company, you could be spending time going right back through what they've said, how they've said it, and learning a bit about them. You're trying to digest the technical detail whilst you're doing that, but you're also hearing the managing director or the CEO's words through their disclosure, and you can measure outcomes based on that. And you can go back through the jobs which they've had as well and see whether they were a success and whether integrity was involved in their disclosure in particular. Because if a company shows integrity through what it's disclosing, then I think you could say that probably spreads through most of the organisation. So I'm sort of bending your red flag question there, but when I see a distinct lack of integrity, and I mean, I don't keep a list, I just have a very long memory for that kind of thing. It's very, very difficult to ever go back to think about backing those people. And, I suppose one reflection which I've made many, many times is that you get to know people, they don't change. So you might think to start with that they're good and they're honest and they're capable, but over time you will figure out whether that's true or not. And you won't come back in 20 years and find that they've turned into an honest person if they weren't in the first place. So I suppose that's a discussion on red flags for me. If someone's not honest, then it's a real problem.
Yeah, that's really, really great advice for investors to go and keep in mind. Simon, perhaps we're going to be focusing on sort of like gold and precious metals. What are the specific green and red flags that you look at when evaluating a gold junior, or indeed like a gold senior as well?
Yeah, I mean, to be honest, I think Hedley's made a very good point there about management investing. I think the only thing I'd add to that is you want to kind of that's a good first question. Are you invested in the company? They'll probably say yes. And bear in mind, you don't have a huge amount of time at these events to speak to people, probably, I don't know, 10 minutes or something. So find out if they've been investing. Now, when they say, yes, I've invested, they may say I've invested $1 million. But one of the things I love about your events, Andrew, is as you go in on the right-hand side, there is a whole bank of Bentleys, Rolls Royces. And I've never been to an event where so much money attends it. Not only are there amazing cars, but there's chauffeurs sitting in them. And at some of your events, you've literally got billionaires. You've got people with huge amounts of money. So if you've got a billionaire who's put, let's say, $1 million into a company, as a percentage of their wealth, that's actually not that huge. So when I speak to people and they say, oh, I put $1 million into a company, and I mean, case in point is someone like Eric Sprott, who's a big investor in the sector, as you know, and it's quite interesting. You can go around and talk to people and they say, oh, we've got Eric Sprott as an investor. And you think that's fantastic. But then what you do is you find out he's invested in hundreds of companies. And so it's not quite as special as you thought it was. So just going back to your question, the first thing I'd ask is, are you invested? Secondly, what's nearby? And then if you've, as I say, if you've got time, look at the bridge system. But when you go back before you invest and you do a bit more research, then I would actually look at sort of how wealthy they are. And I think the other thing I'd add to that is if you've got a management team that has previously made money for investors, the chances are those investors will pony up more money for their current project. If you've got a management team that has disastrously burnt through money, they're going to struggle to raise more money. So going back to Hedley's point, I think it's absolutely spot on, but I would add to that, sort of, as well as their integrity, just look at their success level and see if they've see what they've done, and I think that will help investors decide what they want to do next.
A question that's just occurred to me, either for yourself, Simon, or also for Cailey or Hedley, are there any like online resources that you use? It could be newsletter writers that you go and follow, or particular sort of like online magazines that you read that resource investors could also have access to?
I think, Andrew, one which is great and easy in the modern world is podcasts. And there's a podcast series out of Perth in Australia called Money of Mine. And they not only talk about companies, interpret news, and talk to investors and things like that. I mean, you could listen to 3 podcasts a week out of them and be staying up to date. And there's a couple which they intersect along the way as well. So, I mean, that's, if you were going to do one thing and you weren't doing that, that'd be a good one. And they have a daily email as well, which has a lot of news, probably more Australian biased, but it's well worth signing up to their newsletter as well.
Yeah, I'd agree. I've actually been on that podcast as a guest. It's a very good one. And there's a few others. There's one in the UK, Dig Deep, that Rob Tyson runs. And there's a couple of North American ones as well. So yeah, podcasts are sort of easy because you can be on the treadmill or down the gym listening about the gold market or something. So they're all sort of doing it, but definitely those are the best because they're particularly in getting right up to speed on news as it comes out, hot off the press, so to speak. Those are the sort of best sources these days.
The only thing I'd add to that is if you want to find out about a company, if you go on their website, they often have presentations. Now, obviously, they tell you what they want to tell you, but they're quite a useful way of getting a snapshot of a company, where they're operating, what they're doing, what they view their strengths are, and things like that. They'll never talk about their weaknesses, but if you've got limited time, then you know, the 10-minute look at a presentation could actually give you quite a lot of information.
And I think it's just a really interesting point that you kind of like all of you sort of like raised directly and indirectly, that about honesty and how do you measure your honesty. And it's just occurred to me that when we go and hire people at Beacon Events who produce Resourcing Tomorrow and iMark, we never ever hire a person unless we've met them face to face. We might do like a first round interview on Teams as we're, you know, talking to each other now. But before we make that investment in hiring that person, we have to meet them face to face. And the great thing about events is you get to meet CEOs and you get to ask them questions face to face. It is possible to make an investment, obviously, by sort of like reading this sort of like balance sheet, by reading their online presentations. But coming to events, whether it's iMark, whether it's Resourcing Tomorrow, whether it's some of our competitor events, is meeting people in the flesh and then eyeing them up and saying, is that a person I can do business with? I think you have to meet that person in person.
Yeah, if you can do that, it's a great advantage because you see so much in their body language and their on-the-spot reflections and reactions, which is a lot of people relate to those things in many ways, which are above verbal.
Yeah, if they don't have time to sort of meet and talk to you as a potential investor, then it might mean that they don't care about their shareholders, right? So
yeah,
at the end of the day, that the shareholders are the boss, like, you know. So if they're open to talking and telling the story, that's always the first good sign.
Yeah, Cailey, someone said that to me probably 20 years ago now, that you know, communicating with everybody, and you don't know if they're a current investor, a past investor, a 5% holder, or someone that owns 10 shares. But if someone's got a question to ask, and even if it sounds a bit dim or obvious, it's worth answering it and putting a bit of effort in, because you just never know where it'll lead. So my personal ambition is anything that comes through our info line or email to me from an investor, I answer it one way or another. But I probably value that in the people that I'm meeting as well. If they don't know who I am, you know, their instantaneous reaction is important because they're judging you. And if they judge you as someone they want to talk to without knowing who you are, then that's a great start.
I think I'd add to that, as retail investors, they're probably not familiar with the space like a more seasoned investor is. And quite often the mining industry is incredibly volatile, as we know. And if you've got a very reactive team, if you send a panic email because the share price has moved dramatically, it's nice if someone comes back to you and goes, hey, no, calm down, it's because of this or that. If you don't hear from people, it's quite easy to sort of wind yourself up. So I think that this interaction is particularly important for retail investors.
Yeah.
Good. Cailey or Simon, is for Resourcing Tomorrow, are there any particular companies attending that have caught your eye?
Yeah, I mean, I can't really give out individual names, but I mean, I'll just say, you know, that I'll be meeting and hunting for companies that sort of fit our remit, which is quite niche, you know, for Xcelsior and the guys at Wogan. So it's speciality metals, near to production or into production, and so, you know, in need of finance basically, or some kind of trading support. So it is quite a sort of niche ask, but those are the companies that particularly perking my interest in those speciality metals.
Mm-hmm.
I think, I mean, I was quite impressed. Again, I can't mention names, but I was impressed with the number of large companies you've got. And wearing my M&A head, I think that they would view this as a great way to meet the juniors. And so I'd be surprised if there's no M&A that emanates out of your conference. And, you know, having the big boys there, I mean, essentially, I think it's there for investors to meet juniors and invest. you've got quite a lot of people who are going to your event who don't need money. You know, they've got money coming out of their ears. So you kind of say, well, why are they going to the event? And I think they're going because they can see they can see the future out of a lot of your other attendees. So I actually think that's quite exciting.
Yeah, we certainly are seeing IMARC and Resourcing Tomorrow more corporate development people from mining companies, from the major to mid tiers attending. And we've always had commodity off-takers attending, but we're now getting, I guess, more downstream buyers, which again, is kind of interesting, and that adds sort of like slightly to the mix. Let's ask a fun question, and it's a question for all of you. What is the best mining investment you've made from attending an event, and what did you learn from it? Or what was the worst mining investment you made, and what did you learn from it? You can choose best or worst. I'm going to go to, I go to Cailey first, if that's okay.
Yeah, I suppose I could mention the name. I'm friends with them, so probably the best and the worst. I don't know, maybe. I went to the BMO mining conference in Miami, and met up with Steve Parsons, who Hedley will be very familiar with in Australia, who had a successful track record in an airport. And then so we agreed to have a meeting with him, and this was when I was at my former shop, BlackRock, and that was Bellevue Gold, which he'd just set up. And so we got in incredibly early. I can't remember now. I saw it straight away. It looked incredible. You know, Northern Star team, great track record, historic mine, high grade, easy access, low capex. You know, ticks loads and loads of boxes. Western Australia. So I think we got in at like 20 cents or 20 or 30 cents, and it flew all the way up to like $1.70 or something like that. Yes, thankfully, I've moved on. Since it's blown up, I haven't been on the tail end of it. So that would probably would have been the disaster side of it, I guess, if I'd have stuck in there. But I've moved on to different pastures. But yes, you never know. Chance meetings, what they can lead to. We made a lot of money in those early years.
Hedley?
I think this is a confessional for me. So I think this has got to be a lesson about worst investment or worst investments. And I think when we look back, we do this periodically as well. We look back over everything that we've ever invested in, and most of those things we've sold by now. What has gone best and what's gone worst, and try to isolate the reasons for that. And I would say that one of the overarching failures in due diligence that we've ever had is not, I don't think we've ever really been wrong about a project in terms of its technical, is the geology good, etc. People, we've got them right and wrong. But I think where we have been led by people more, and probably been naive, is where we've judged a jurisdiction to be more investable than it really is. I think by and large, probably from the noughties onwards, we'd seen metals traders probably gentrify much of the world, which was tough before that, and they'd done so by being quite brave and investing to open up commodity flows. That enabled China to extract metals from many places, and it enabled a lot of metals companies to build those projects, and it took banks into regions that they probably never would have gone into. That was probably more anomalous than the 80 years of history before that. And I would say that we're probably going back into more normal now than necessarily seeing a jurisdictional adjustments. Some of the worst jurisdictions are getting worse. I wouldn't say the best ones are getting better, but the worst ones are definitely getting harder. And I mean that in terms of asset confiscation, nationalisation of parts of assets, supply chain disruption, things like that. So that's where we've had our biggest problems. And the problem is that, if you found you've got a managing director who's dishonest and you own 20% of the company, you might be in a situation where you can rectify it. If you found that the geology isn't quite as good, but you've still got part of a project, you might be okay. But if the jurisdiction turns out that it's really tough, you're dead in the water. And that's been a problem for us in one or two things that have been very, very, very difficult extractions. So I suppose the lesson for me and the warning for investors is don't be naive about jurisdictions. Ask a lot of questions and second guess yourself.
Simon?
Yeah, I mean, my best investment, and I think Hedley earlier was talking about luck, and make sure you don't think you're smart when you're lucky. I invested in a company called Chalice at I think it's about 13.5 cents. That was at one of your events. For all the wrong reasons. I invested because they were next to Fosterville South, which is one of the highest grade gold mines in the world, and they made a massive discovery in Western Australia near Perth. Their shares went from 13.5 cents to over $10. So you don't have to be a rocket scientist to work out that you make a lot of money. I lost my nerve at around $3-4 and sold out. I've got friends who stayed in, but you were literally making or losing a Ferrari on the trading session, which I couldn't really. I describe it as a high quality problem, but it was certainly a problem. So that was probably my best. I don't want to mention my worst by name, but it was from your event where.
Sorry about that.
They made. They had an asset that I loved, and I thought, yeah, I'm going to invest. I want in on that asset. They went and sold the asset. So the whole reason for investing, they'd sold. They then went to try and buy another asset and failed. And I learned so much from this investment. I obviously I knew the CEO and I spoke to him and said, how much money have you got in it? None. What's your track record on investors? None. And going back to the integrity question or integrity point, I learned so much from this bad investment that perversely it's actually worked out quite well, because I did so well on Chalice that losing money on this company didn't make a huge difference. But it was a painful but I suppose rewarding experience.
Hope you didn't lose too many Ferraris on that second one then. I was just looking out your window to see if I could see any of the ones that you
No, there's an Audi somewhere. I've moved down from my other half, she's a social worker, so turning up to work in a Ferrari with a social worker doesn't make huge amounts of sense. But yeah.
I was just kind of thinking, so if I've been asked the question, because it actually leads into another follow-up question, is years ago, I forget it was 2015 or 2016, I bought into Northern Dynasty and it went up tenfold, and I was feeling really proud and like clever about myself. And then I think I went away on holiday for a few weeks and I came back and it could have dramatically dropped down again. I think I still made a fourfold profit, but I remember feeling really like hurt and a really bit sort of like hacked off. And I think that leads me to my next question. I'm a typical retail investor. I'm absolutely brilliant at buying shares. I'm absolutely brilliant at investing into companies. What I'm absolutely terrible at is then choosing the right time to sell. I am horrific at that. So I know this kind of webinar is primarily about choosing which companies to invest in, but what's your advice for retail investors about when to go and sell or when to go and take profits?
Yeah, I think you need. At the risk of answering for others, I think we're probably all guilty of that, particularly when you're long only investing. I mean, the hedge fund guys have a very different remit, but we've probably all been guilty of that at the time. And it is hard, particularly when you've done all the work, you've met the management, you've invested a lot of time and effort, you've seen some success, you can see something just around the corner like management can. It sort of hangs you in there like a carrot dangling in front of your eyes. I mean, my experience over the years has been, if you've made a good profit and there's liquidity in the market, then you should always take at least some of that while you've got the opportunity. It doesn't have to be all of it, but certainly some. Bank those profits. Don't fall in love with it too much. I think that at the end of the day, it's an investment. And I think the final thing is constantly check your investment thesis. And if there's any reversal or change to your original investment thesis, or your investment thesis might evolve, but if there's drift from that original thesis that it's not what you were there for, then that's the time to just move it on. Even if you're at a loss, just cut the losses and move on to something else.
It's really hard to improve on that advice, but I think everybody gets emotional about stocks that they hold, because who gives a stuff about stocks that you don't hold? You've gone to the effort to buy it. You become emotional about it because you're reading about it, and that might be every day, every week, every month, maybe just once a year, but you're probably more emotional about those things than things you don't hold. And to that point, you've got to remember why you got in there. So like you say, your investment thesis, if you've invested in an explorer and you thought they were going to find something and you find 12 months later they haven't, that's a signal to say, you've probably overstayed your reasoning there. And if you've invested in something because you thought the gold price would make their shares go up, well, if their shares have gone up, it might be time to think it through, because, unless you're watching these things carefully every single day and watching for the fundamentals, if you've made a profit, you're much better off being in for free by selling some of your principal and returning profits to the pool. So yeah, I think I've just said everything you said, Cailey, but in my simplistic Australian.
I'm going to add to what Cailey said. You should never fall in love with anything that can't love you back. And I think a mining company will never love you back. But it's a brilliant question. But you have to be so careful, because it's one of the few areas where I don't think there are signals. You can think, oh, it's a good time to get out of this company, and they make a massive discovery. Or you think, I'll stay in this company, and they put out some really bum results, and you're like, watch your share price tank. So personally speaking, I like to look at the portfolio. And so what I tend to do is, I look at the overall portfolio, and there are, let's say I've got 10 companies. There's probably 7 I really like and 3 I'm less keen on. And I'm more likely to sell the 3 I'm less keen on than, and then hold on to the 7 I really like. And so I tend to look at them not in isolation, but as a portfolio. And I'm not saying that's necessarily right, but I just find it's psychologically an easier way for me to look at it, because if I start picking companies to sell, especially if I start picking the ones I really like, if I sell them and they fly through the roof, then I'll feel a little bit dumb. But just to add to that, mining companies, if we are at the bottom of the cycle, even the very large ones can easily double, treble in price. So I'd say don't be greedy. Just sort of use a bit of common sense, and you're there to make money. And if there's a company you really like, you may want to hang on to it. But if there's a company you bought and perhaps the reasons for buying it have changed a bit, then you may want to think about selling it.
Yeah, and I think that you and I in the past have talked about your sort of football team analogy, and that's kind of like how you sort of like view your portfolio.
Yeah, absolutely. I mean, I have goalkeepers, defenders, midfielders, and the forwards are explorers. So a goalkeeper would be a massive company like a Newmont or whatever. A defender would probably Evolution. Midfield is more like an Equinox or something like that. And then you have the forwards, which are, quite a lot of them go to Resourcing Tomorrow. And so what I tend to do is look at them as a group. And if I've got an explorer that's got cash, that has done some drilling, and I'm waiting for the results, I'll probably hang on to them. But if I've got an explorer that has got no cash and the share price has tanked a bit, I may just cut my losses. I may kind of sell something else to sort of counterbalance it a bit. So if I've lost there, I've made some money there, so I'm net profit. But yeah, you have to be really careful. And I think that investing in the sector is as much about strategy as it is about stock picking, to be honest, because stock picking is, yeah, you can get lucky, but you can also get unlucky.
One final question for all three of you. We've talked a lot in this webinar about mining companies and how to invest. We've obviously touched briefly onto commodities as well. If there was like one particular commodity trend you would say that retail investors should be aware of over the next 12 months or so, what would it be and why? Maybe I go to yourself first, Hedley.
I'm going to steal everybody's thunder here, and I'm going to be Captain Obvious. If you think that you want to invest in the commodity space, don't ignore gold. I mean, it's gone up strongly, but when gold gets into a bull market, it goes somewhere between 5 and 10x, and so far it's done maybe 2. So I think something which is already going up has a very, very clear buyer behind it, which is being driven by a fundamental of, well, can I avoid US dollars? That's Mr. China speaking. I think that's a great place to start. Now, broadly, I think a lot of commodities are going to be positive, but if you want to pick a bottom and try to really nail that, it's going to be hard. So for 12 months, gold is where I'd be looking. Simon?
Yeah, I wouldn't disagree. I mean, I think gold is the direction of travel is very clear. Speed of travel less clear, but I think it'll go up. But how quickly it goes up is a different matter. I'd probably add silver to the mix if I'm honest, because gold is all-time highs still going up. Silver is, I think it's about 40, 41 now. It's previously been 50, so it's going up and it's nowhere near its all-time highs. So gold is my number one, but I'd probably have a bit of silver as well.
Cailey?
Yeah, I love those. I've got to talk my own book a little bit, I guess, and talk about some other commodities. Everybody loves copper, but I'm probably less excited about that than some of the smaller commodities that have moved, to the critical metal space, and the rhetoric has shifted from ESG, green transition, to strategic. And we've seen that massive disconnection with all the US tariffs and the China export restrictions coming in, that a lot of these supply chains are broken now, and we've seen huge volatility in some of these minor metals like antimony. It's gone from $7,000 a ton to $60,000 a ton. It's very positive on that. Tungsten is just sort of starting that trend as well. Rare earths, we've seen the US come in and support projects, domestic projects with a price floor. So I'm very excited about those sort of specialty metal space there. I think there's a lot more room to run. Not in all of them, but certainly in a few, particularly the ones I mentioned.
Well, thank you very much for that. Cailey, Simon, Hedley, it's been a pleasure having you on this webinar. Thank you for sharing your invaluable advice and insights with our listeners. For those attending IMARC and Resourcing tomorrow, I hope that this helps you navigate these exciting events. Thank you very much. This was Andrew Thake, Divisional Director with Resourcing Tomorrow.